I hope everyone's having a good day today. My name is Jesus Azanza, and I'm the Executive Director for the Greater Houston chapter of CAI. CAI is a member-driven organization that represents the interests of community associations in our region, state, country, and really across the world. Today's presentation is a great example of how our chapter leverages our membership's expertise to meet the interests and ongoing needs identified by community managers and volunteer board leaders. As with all of our presentations, this course is approved for 1 CEU, and you'll receive the presentation materials and CEU certificate after we finish. The presentation is also being recorded, and we will upload it to our YouTube channel afterwards. We have a great presentation today, and I'm going to jump right into the introduction so we can get to it. Andrew Stoutenberg is Regional Executive Director for Reserve Advisors. Andrew joined the company in 2013 and received his Reserve Specialist designation from CAI in 2015. He has worked with community association managers and board members across states and is a frequent speaker and presenter at trade shows, seminars, and workshops. Cynthia Burns, our other presenter, is Vice President, Regional Account Executive for CIT, a community association banking partner. Cynthia has been a member of the Houston, San Antonio, and Austin CAI chapter since 2011. She currently serves on the CAI Greater Houston Board of Directors and has served on multiple committees throughout the years. She earned her CMCA as well as her Educated Business Partner designations in 2012. CIT is also a gold level premium partner of our chapter, and we appreciate her volunteerism and expertise. Thank you, Cynthia. Today's webinar is sponsored by Lake Management Services LP. Jeff Garner is here to tell us a little bit about his company and how they can serve your communities. So Jeff, thank you for your support, and I'll let you take it away.
We appreciate the opportunity to sponsor this. Reserves in general are very dear to our heart because we know we have equipment that has useful lives out in the field, and with over 2,000 units in the water, being able to get associations to understand that these things, although they work probably 20 days, they work 18 hours a day, 5 days a year. At some point in time after 10 years, it's about time to replace them, and being able to have the board in a position to where they can make a capital reserve expense to replace that, and just having every manager have that ability and that knowledge base to help their boards across that makes our lives and the manager's lives so much easier. So we thought this would be a great opportunity to sponsor, and we appreciate CAI's opportunity to let us do that.
We appreciate your support, and Jeff also serves on our gala committee and has been instrumental in that event's success, so we appreciate your dedication. As we move forward through the presentation, please make sure to mute your mic and feel free to use the chat feature to submit questions to me directly, and I will coordinate those with the presenters during the Q&A portion of the webinar. After we conclude, we'll randomly select 4 participants who will win a $25 gift card. Sponsors are going to stick around for about 10 to 15 minutes after the presentation, so we'll end it, and then for those of you who have any questions, feel free to stick around and we'll get those answered for you. That being said, Andrew, my piece is done. I'll let you take it from here.
Awesome, thanks. So yeah, thanks everyone for attending today. I got up here our agenda, so we're going to cover 4 sort of areas. So I'll start off first just with really some reserve study basics. Cynthia will touch on investing reserves and how to leverage that. And then we'll close out with another topic from each of us. I'm going to share a story from a client that was in a significant underfunded situation, and just show how the reserve study pairs with a lending institution to allow a community to borrow those funds, and sort of how that's orchestrated and the ins and outs of that. And then again, at the end, yeah, we'll have time for some Q&A, so happy to answer any questions that anybody has at that point in time. So with that, reserve study basics, and we got a lot of people on the call, and I understand some of you are probably more or less experts, but there's certainly going to be some people on the call that maybe are very, very unfamiliar. So I'll try to thread the needle and hopefully provide something of value to everyone. So to start off, what I think sets the good stage is understanding, what is a reserve study, and so for a report to be considered a reserve study, there's actually a set of standards. And I decided I didn't want to bore everyone with let's just read through those standards and talk about every aspect that's contained within them, but rather there's a few things that we really should understand because it guides when a reserve specialist comes to a property and conducts the inspection and then produces a reserve study. There's a couple of things that are really important to understand that relate back to those standards. And so what you see on the screen here is sort of what we commonly hear called the 4-part test. And so what it is it's been defined that for any common element, or I should say any expenditure to be included in a reserve schedule and therefore the reserve study, has to pass these 4 tests. And so I wanted to just sort of talk through these and explain them and speak to them a bit, and we'll sort of circle back on them. The first one sort of feels obvious. It needs to be association responsibility, but it's really important to draw attention to that. There's plenty of times where when working with a client, they share with us that they want us to include X, Y, or Z. Maybe it's painting fences at the homeowner lots. If it's not legally the association's responsibility, generally you don't want to have that as a reserve expenditure. So right off the bat, that shouldn't be included in your reserve study, okay? The next 2 points are interrelated. They both relate to lifespans. So the first one is saying a common element, it needs to have a limited useful life. And to understand that, a reserve study has to be 20 years. And many studies now, you'll actually see their 30-year projections. That's what we also depict. And actually even further, a lot of providers, even if they're providing you, let's say, a 30-year plan, a lot of providers, us included, we actually look an additional 10 years beyond that. So we're actually really looking at a 40-year window. So limited useful life means the expenditure needs to occur in that window. So the best example to think about here, subsurface piping, stormwater piping, drainage elements. If we're at an HOA that's brand new, it's not probable or likely that we're going to replace that subsurface piping in the scope of that study. Now, that doesn't mean that that will never be a reserve expenditure. Actually, flash forward, or maybe the next day I go to a property that was built in the 50s or 60s. Well, now that limited life starts to come into play. So it just depends on the point in time that the study is being conducted. That would be the determining factor if this is going to be a project that's included or excluded. And then also related to useful lives, that third bullet here is predictable. So we have to be able to put a realistic projection on when that project will occur. A reserve study is a roadmap. It's an estimate. It's a forecast. It's obviously not absolutely 100% correct on every single element, but we do need to have some predictableness around those expenditures. It's not intended just to be a wild guess. And then the last one to hit on here, it says above a minimum threshold. Now that amount is unique to each property. The way I describe that is it's simply in place so that one, the reserve study doesn't get bogged down with dozens or hundreds of extra line items or components that are so insignificant from a financial standpoint, they have next to no or no impact on the reserve funding. It sort of just bloats the study, and it's not going to sway the output of the study. So it helps keep the study digestible, is how I think of that. So it's good to understand, all of that. That's sort of the baseline. You have to pass all of those tests to then expect an expenditure for whatever asset you're thinking of including in a reserve study. So the reserve study, once we say, okay, we understand what can be in the study, well, what exactly is that study? Well, it's broken down into 2 parts. There's a physical evaluation and then a financial analysis. And I'll talk to both of these, but I'd like to also point out here, what is the purpose of a reserve study? And the first one is, well, we want to know what to contribute in reserves next year. And yes, that is the purpose, but it's actually a little bigger or broader than that. As I mentioned, the study is going to cover 20 years at a minimum, typically 30 years. And so it's not just about the next year, but it's really about having adequate funding over that entire time period. And adequate funding means you want to never have negative cash balance. So you will be cash positive that entire period of time. And by doing so, you're minimizing that risk of special assessment. So that's the rationale is, we're balancing the expenditures with the contributions in to be cash positive the entire time. So we'll talk more about that in a moment. But on that first half, the physical evaluation, I break that down further into sort of two main things. So this is the part of a reserve study that's on site, right? It's the reserve specialist coming to your property, and there's two main categories of things occurring. There's a meeting, and then there's the actual inspection of that property. So first, to look at that meeting to understand what the purpose is. So that's going to be the reserve specialist meeting with either manager, board members, committee members, all of the above. In this current time, there's actually a lot of these are no longer face-to-face, so it's either virtual or over the phone, but it's still dialogue, right, between the reserve specialist and representatives of the association. And what's the purpose? The first bullet point here is scope of responsibility. So if we think back to that 4-part test, what was the first thing? It has to be association responsibility. So this is a really critical part of this meeting, because reserve specialist needs to know, are these streets private, or are they a county or a city or a MUD maintained element? Is this wall on the west perimeter, is it the HOA, the homeowner, a neighboring community? Right? That's a really, really important part of the conversation. And I always want to make it clear, that has to occur, that conversation. If nothing else does, you can still create a study, right? I could still make a reserve study with projections of costs, lifespans, and that's going to sort of be your baseline. It's going to be a study, it's going to be useful. Well, how do we make that a better study? How do we make it more useful? Well, we need more data, more information in. And so as part of this meeting, we would then want to move on to understanding as much about the property or community as possible. So that's things like history of capital projects, what's occurred, how long ago, what's planned this year, what's planned next year, what are the concerns, right? All of that information is going to help create a better product, a better output. And then the last point over here, really brief review of operating budget. I'd like to just draw attention to this, and I'll use an example now and a lot because it makes it easier, is if we imagine a simple HOA with a pool, if in their operating fund, they budget for replacement of pool furniture, well, we don't want to budget for that in reserves, because now we're actually double accounting for it. And then opposite of that, if it's not budgeted for in reserves, or excuse me, if it's not budgeted for in the operating budget, and I also do not put it in a reserve study because I just assumed it would be in operating, well, now it's not being reserved for anywhere, right? So we don't want to double up, but we also don't want to omit anything. And then also related to that, I use the example pool furniture. We could use a whole host of examples. And it's not to get bogged down in the should this be in reserves or not, because think of it this way, the homeowners, the community is still paying for it. It's not really an important argument of should that be reserves or not. We just want to make sure it's allocated for somewhere, right? It's a common element. And so from that meeting, and that's typically an hour or less for an average property, it can vary. But then we're going to look at the inspection. So what is a reserve specialist doing on site? Similar to that meeting where we have to at least know, baseline scope of responsibility to create a sort of standard baseline reserve study. Without much detailed of an inspection, you could still create a reserve study. We could say fences last 20 years, fences cost X dollars per linear foot, and you have 100 feet. You could type that in and say that's our projection, right? And that's not inaccurate, but it's sort of a baseline. And so through a detailed inspection, all of the aspects of that example I just gave can start to be refined. The quantity of fence doesn't change, but what about the condition? Is it the same throughout the whole property? Are there areas that need replacement sooner than later? Are we adjusting life expectancies? All of that's very critical to be determined during that inspection. Also, manner of replacement. Are we replacing it all at once? Are we replacing little pieces of it over time? Factors affecting replacement costs. I think let's stick with fences. Great example here is if we have two properties, they both have 1,000 feet of fence. same exact material, everything, you would think, well, it's the same replacement cost. But how it's constructed, where it's located, could really change that. If one community, it's 1,000 feet just on the perimeter, really easy access, but the other community, it's 100 locations of 10 feet of fence, it's going to be a lot more challenging and time intensive for a contractor to replace it at that second community. So on paper, it would look the same, but in reality, it's quite different. And then also through that inspection prioritization, what projects need to occur first. If we're in a funding shortfall, we may need to do a lot of near-term work, but realistically, we have to defer some projects. It's really through that inspection that a reserve specialist is able to figure that out. So that's all under the physical evaluation. And that other portion of the reserve study, right, is the financial analysis. This is the output of the study. And this is what gets a lot of attention because you receive a reserve study and it may unfortunately be saying you need to increase contributions, potentially significantly. And, I live in an HOA. I don't want my dues to go up, but unfortunately the study may be telling you that. And it's easy to focus on that number, but we always have to remember that number's the output. Right? A reserve specialist isn't picking that number for fun or because they think it's a safe number or anything like that. They're arriving at that number as an output based on the expenditures. So when you receive a study, either for your own HOA or as a manager for a property that you manage, don't look at that number and react. We have to say, well, what's driving that number? Look back to those expenditures. But to talk about that number, let's understand the financial analysis. So there's a few ways to do it, but what I have on the screen here, it talks around the concept of cash flow funding. And we'll actually see this in a few slides visually. It's a bit easier to understand, but it's pretty simple in nature in that it's cash in or contributions, which are relatively stable, are offsetting the variable annual expenditures, right? Because if we think long-term for a property, the expenditures aren't consistent, right? There's years of really high expenses and years where maybe there's almost nothing being spent from reserves. So it's very variable, sort of repetitive there, but we want those contributions in not to be wildly fluctuating. And then, so how is that number, the contribution, and how is it determined? Well, what is the right amount? Well, that's what's defined here as threshold funding. And again, we'll see this visually, it'll make a little more sense. But the goal here is that whatever the contributions in that are being recommended, the reason those numbers are chosen is it's ensuring that the reserves are always cash positive, as I mentioned, that they're adequate, but also not excessive throughout the whole duration of the study. So said another way, there's probably going to be years with relatively low reserve balances, but it's never going to be negative. And we're going to draw those reserves down to an acceptable sort of threshold lower limit amount. Again, we'll look at that visually, and I think it makes more sense when you see the charts. And then, so that's the two pieces of a reserve study. Slide I have here, I like to talk about, calling it overlooked elements. Now, what I listed here, this is just a handful, right? Some of the more common ones. The point is, what we've found over the years is, for a given property, there's the obvious expenses. If it's a townhome community, pretty much everyone understands roofs aren't cheap, repaving your road isn't cheap, you have to replaster a pool. That's all right in front of you and obvious, but the reality is there's a lot of other elements that maybe aren't right in front of your eyes, or they are, but you have this feeling it's going to last forever. And it's easy to fall into that thinking, but again, remember, if we're at a property that's already 20, 30 years of age, we're running an analysis covering the next 30 years. An element or something like a light pole that you think lasts forever, well, is it really going to last 60, 70, 80 years? The out-of-sight elements, infrastructure elements. I mentioned subsurface piping earlier. That could be underground. We also could have building internal plumbing, things like that. They're completely out of sight. And when a property is really young, yeah, probably not going to be in the study. But as it ages, these things, these elements could actually be significant cost factors in a reserve study. So that's important. That's why it's important to make sure you have a detailed study that's really assessing all of these components that, at first glance, maybe we think aren't important or aren't going to have large expenditures. So with that, what I want to do is just look at a few sections of a reserve study. Again, trying to stay pretty high level here. We can drill down at the Q&A or following this if need to, but where I wanted to start on you have a reserve study in hand, what do I do with it? I'm always going to draw anybody's attention to the executive summary, right? When I send a study and I get a phone call, I tell you this, open up the report, page 1, right at the front. That's where we want to start. Because a lot of information is going to be contained right there. And these studies could be 50, 70, 80 pages long, right? So that's a lot to digest. And if you don't work with the study every day, like I do, it can be somewhat daunting. So I'm always going to say, go to that executive summary first. If you're a manager, if you're a board member, it doesn't matter. You can start to understand a lot about what the report is recommending from these one or two pages right at the beginning. So on the left, I listed some of the things that are contained within the executive summary, just to dive into a few of them. One, it's going to clearly tell you your funding goal and method. As I said on a prior slide, cash flow funding using the threshold funding methodology, that's one way. We could also have percent funded, which is just a different way of calculating and measuring the reserve fund strength. Another question I get so often on a call after we've shipped a study is, how are these costs determined? Well, that's stated right here in the executive summary. Where did your reserve study provider arrive at these costs? How are they figuring them out? Another really critical thing is the reserve fund status. And so, this is a number that's reported to the reserve specialist, right, by the association. It's typically just your balance sheet, and okay, here's where we're starting off. It's important to know this is stated right in your executive summary because the funding plan covering that 30-year period, it's iterative. So if the starting point is wrong for whatever reason, maybe I fat-fingered it, maybe I was working off a balance sheet and 2 months later you had a big swing in funds that came in for whatever reason, if that starting point is actually significantly off, that could really affect the funding over those next 30 years, right? So that's important to know. And then really, why do we get a reserve study? We want to know what to budget. So of course, in our executive summary, the funding recommendation is going to be clearly spelled out right there for you, telling you where you're at today from a funding standpoint and what you need to do to get on track over those next 30 years. Next, what I have here is the expenditure schedule. This is the meat of the report. This is where all the data lives. And now what you see on the screen, this is what our expenditure schedule looks like. If you have a different provider's report, it's definitely going to look different. But what's important to understand is any reserve study you receive, all of this information's in it, right? It may be slightly depicted differently, but all the data, it has to be there. So if we go back, there's those standards and every study has to meet those. So, it may take a little getting used to how different providers depict it, but it's all right there. And again, I'm not going to dive too deep into this, but what's good to know is a couple things. One, if you don't see it on your reserve expenditure schedule, it's likely not being funded for out of reserves. So if you look at the schedule and you say, well, there's no playground equipment, that means likely it's nowhere in your reserve schedule, so it's nowhere in the reserve funding, meaning it's not being saved for. Now, with that example, there may be a reason, it could have been overlooked, but that's a good starting point. If it's not on the list, not being reserved for. And so also then what you can get from looking at the schedule is what is the value of that element today? Today's dollars. If we replaced for this example, if we replace all the light fixtures today, this property, that would be about $7,500. But what's also critical is, well, for this sample property, those light fixtures have a 12-year life remaining. So they're actually going to be replaced significantly into the future. And so, well, we all know it's going to be a higher cost. It's going to have inflation. So you can also figure that out. What are our actual future cost projections compared to today's costs? And then this, you only see the first 5 years, but again, it would actually cover 30 years. And that way you can look out in the timeline there and sort of see what projects are occurring when, which ones are coordinated, what's more towards the left of the schedule, meaning it's near term, it's prioritized. All that information, that's right there on the expenditure schedule. We can talk about it in more depth later. And then that output, this is the funding plan. And this is, this is where we figure out what are the contribution amounts needed to maintain, again, that adequate, not excessive reserve amount. A lot of numbers on this page. I think it's easier just to look at it visually. And so that's what we have here. We'll flop back to that slide in a second. But I want to sort of explain this chart. So we have these green bars. Those are our reserve contributions. We have the red bars. Those are our expenditures. And we have that blue line. That's our year-end balance. So now we can start to see how this is all playing together. So looking at our expenditures, looking at our contributions, we see that it's slightly increasing over time. That's just inflationary. As time goes on, we want to collect a little bit more per year, but it's relatively stable, right? No huge surprises. Whereas looking at the expenditure, those red bars, as I mentioned, it's variable. There's years in this example with over $500,000 in a given year. There's years where it's zero or next to zero. And then the reserve balance is that blue line, right? So it peaks and then it draws way down low and then it peaks again and then it draws way back down. So that's that concept of threshold funding. So you need to always remember the funding is over that 30-year time period. Because if we were to flash forward to, let's say, 2040, 2042, this property would be sitting on about 1.2 million in reserves, which would feel excessive. It would definitely feel excessive if you look the prior couple of years, they had relatively low expenditures. But again, it's all for a purpose of over time that balance is going to draw down. If we back up in time and look in year 2028, 2030, that's a period of time where those reserves have drawn down to critically low, but still adequate year-end reserve balances, right? So important to see how all of that sort of ties together. And so then just to look at those numbers again, and this will obviously vary based on the size and scope of a community. But for the example we have on the screen here, I mentioned they're going to peak at 1.2 million in reserves at some point in time. If you look closely, if you can see it, we do factor not only those reserve contributions on an annual basis, but we also do build in some interest earned, right? And so with a community of this size with significant reserve funds, that number can be relatively important, and it can help offset some reserve contribution amounts. And so that's what Cynthia is going to touch on is, when you are in a position where those reserves can be strategically invested, how do you go about that? And so with that, I'll turn it over to Cynthia here to cover that.
All right. Thank you all for joining. That was great information, Andrew. Thanks for taking us through that. For the second segment, like Andrew said, I'm going to go over how to strategically invest funds. So what are the first steps, right? Community manager or board of directors, what are their first steps in looking at their reserves? We're going to go over the type of investments that are available and then what to look for in a banking partner, because that is very important. So let's jump right in. First place to look, of course, are governing documents. So during my research, I found that the state of Texas really does not have laws in place that dictates how a community association should invest their funds. What board members have been told over and over is it's your fiduciary duty to, basically act in the best interest of the community. But really, they don't give step-by-step or practical tips on how to do that when it comes to money, which is pretty scary because you're really working with other people's money, right? It's not yours as a board of directors or as a manager. So managers, this should be shared with your boards if this presentation, or definitely speak with the experts, but also just practical steps that you can also take as a manager to educate your boards. Is number one will be to look at governing documents, because some will say how reserves can be invested. If documents are written before 2000, they might be silent, which kind of leaves you again in dead water. Some might say something like reserves can be used for capital expenditures only, which also can be very limiting, especially if at the end of the year, operating funds are very low, right? You want to be able to get into reserves if needed. Here in Houston, a lot of the communities collect money up front, right? January through May, they're pretty top heavy when it comes to dollars. And then at the end of the year, it does taper off. So you definitely want to have some wiggle room there. And then step 2, if there is nothing in your governing documents, you've worked with your attorney, your CPA, you've had those conversations, I would definitely say to have an investment policy or pull that out if you have one. This is very critical that every association should have. And if you don't have one, I would say to reach out to me. I do have templates I can provide to you, but this should really be the guide and a very easy to understand policy where someone with a lot of financial and banking background should be able to pick it up and really know exactly how their investments should be, how they should be invested. And then even if someone has no experience, they should also be able to pick it up and make wise decisions for the community. So the policy should have specific goals. It really should list, every association is different, so you definitely want to make sure that you meet with your board, you get the experts involved, and you really just talk about what the goals are for that association. So for example, maybe an association wants to always have 2 times the amount of their insurance deductible at all times available in liquid format. Maybe they want to only have their association money in FDIC products. That can also be something very specific to that association they want to add in that policy. Maybe they just want all their money to be in a highly rated bank. They want to make sure their funds are secure, and that should always be priority. And then of course, step 3, you just always want to utilize your experts. Contact your attorney, your banker, your CPA, and your reserve specialist as well, because they definitely help with the investment policies. Okay, so next is the type of insurance for reserve funds. We're going to talk a little bit about FDIC insurance. This can be very tricky, and I know I get calls quite often asking about, are my association's funds insured? Are they protected 100%? So FDIC insurance protects your association's funds up to $250,000 per bank and per tax ID. Okay, so I get a call. This is an example. I get a call from a manager on the way to a board meeting, and she says, "Hey, I have 5 accounts with you. I want to make sure they're all secure. They're all 100% FDIC insured." And the problem with that is it doesn't matter how many accounts you have with any bank. It could be 1 account, it could be 10 accounts. It's really a combination of those deposits. So you want to add the balance together and see if it's over $250,000. If the funds are over $250,000, there is a potential for exposure there. But don't panic, because most banks, especially if you're working with a homeowners association bank, will have protection and will have products out there to make sure funds are 100% protected. So again, my recommendation would be to pull out your balance sheets as managers and just take a look, contact your banker, and make sure your funds are secured. Make sure they're in a reserve account that is earning interest. And have those conversations, because it really is, it's not just about rate, it's really about let's strategically look at, where your associations need to be based on the reserve study. And we'll get into that here in just a little bit. SIPC insurance is a securities type insurance. If you're working with a brokerage firm or like a Edward Jones, Fidelity, Smith Barney, they're really going to have a different type of insurance. So you definitely want to talk to them, ask them what the insurance that they cover does cover for the association to make sure you are protected. Okay. Next is the surety bond, and this is a type of protection that's been around a very, very long time, and it's not as popular as FDIC or SIPC, but it is gaining popularity with homeowners associations. The main reason for that is that your bank can protect your funds 100%. So there's no need to chase, the best rate around town. You don't have to have multiple banking relationships. No need for multiple signature cards. And really, what it does, once the bucket of the $250,000 of FDIC is the money is there, then additional funds would go through the surety bond process. There are no costs to the client or the association or the management company. And there are signed disclosures to get into this program. And really what it does, the bank purchases this third-party insurance. The surety company will issue the bond to the management company or to the association, and then the bond is held with that customer. Okay, so you know you're protected 100%. Basically, you have the comfort of knowing your funds are protected. And another benefit is that, again, depending on the bank you're working with, the bank will regularly monitor these accounts. So like I mentioned before, here in Houston, we get a lot of money in January through May. The bank will look at that and purchase additional insurance if needed. Okay, so again, you have the comfort of knowing your association's funds are protected, and as well as your board members. Okay, so next is what I call Cynthia's pyramid of priority. This is really a visual on what the priorities should be when the board members are looking to invest funds. It's definitely my priority to start at number 1, which is coverage. Should be your priority and your association's priority. 2 is liquidity, so having the money available when needed, and this is huge. This is where the reserve study does come into play, and we will ask, what projects does this association have in the next 5, 10, 15 years? Let's really look at when they need their money to make sure they're in a product that is going to be available when needed. So we definitely don't want to tie up the community in a 3-year CD knowing they're going to need the funds in 6 months. So again, it's a consultative approach that your banker should be, talking to you about. It's definitely not what's the best rates, or send me your rate sheet. What rate do you have for 1-year CDs? We really should sit with you, look at what the association's goals are. Let's see where the money needs to be. Let's make sure it's covered. Let's make sure the money is liquid when it's needed, when projects are coming up. And then the third is definitely interest rate. So this is absolutely a factor. I'm not saying, throw that out the window, but it shouldn't be the first priority. So normally, again, when I get into rate conversations with board members or with managers, this pyramid is totally flipped upside down, and it's, well, just put me in the best rate. And that's really not, we're not going to recommend that you always get the best rate, right? We want to make sure that, again, protection, liquidity, and then of course the rate. Okay, so next I'm going to jump into the account types. This is, you're probably very familiar with a money market. You probably have that open currently for your communities. This balance is included in the FDIC limit. It is a liquid account, meaning you do have access to it when needed. There is 6 withdrawal limits per month. Currently, the restrictions for that have been lifted due to the CARES Act related to COVID-19. So you definitely want to talk to your bank if you do need additional funds outside the 6 withdrawals. That shouldn't be a problem right now. This is a variable rate, so it can change. And there are opening deposits. Usually it's a smaller amount for these type of money market accounts. Okay, next is a CD, or certificate of deposit. These balances are included in the FDIC insurance limit as well. They are timed investments with fixed rates. And there are early withdrawal penalties that may apply. So again, when we're looking at the reserve study, we're looking at when projects need to come into place. We're definitely not going to suggest a longer term CD because we do not want you to lose any of the interest that you've earned. We also don't want you to potentially lose the primary funds, right, the principal. So make sure, again, we're having the conversation about these CDs. Okay, the next account type is a CD ladder. And this is a great strategy where you take one large amount of funds and we disperse them into multiple CDs with different maturity dates. So in this example, you'll see this association had $40,000 to invest. And what we did was stagger the CDs every 3 months, so that every 3 months, the association has $10,000 available to them to use if needed. If the funds are needed, perfect. Redeem those funds and use them for projects. If not, we can start a next ladder, right? And keep the money being reinvested. So again, potentially you're getting a very good rate on all the CDs, and then they're available again when needed. Okay, so next we're going to get into CDARS and ICS. And these are 2 products that are available for, again, anyone who has over $250,000 that needs that FDIC protection. CDARS is a true CD account. It's a timed investment with up to $50 million in FDIC coverage. The great thing about this is you are working with one bank. You get one rate and one statement. So again, not chasing the best rate, not chasing signature cards all over town. It's really an easy, convenient product for your associations and for your management companies to use. There's also the ladder CDs are available with the CEDARS program. Next is the ICS account, and this is an insured cash sweep product, and it does protect for up to $10 million in FDIC coverage. We can connect it to a current operating account to make those transfers a lot easier. The rate does fluctuate just like the money market account does with the 6 withdrawal limits. Of course, that's also lifted right now. And there usually is a higher minimum opening deposit. In this case, it's $50,000. So there is some setup required. Typically, the clients use ICS are going to be clients who want accessibility to their funds, but also maintain that FDIC protection. Now, you can use a combination of these funds as well, or these products as well. So you don't have to just use one. I would say, again, talk to your banker, pull out that balance sheet, and really find the products that are going to work for you and your community. Okay, so next, just something to think about when you're working with your bank. Some questions to ask any banker, any bank that you want to put deposits in. I would absolutely ask these questions. Many banks can open accounts, but really, are they going to be that consultative, one-on-one, with your boards and really come up with a plan so that they can place their funds in great accounts that keep the money protected and also gain a good yield, right? So you definitely want to ask questions like, how long have you been doing business with associations? How long, how many associations are you currently doing business with? That says a lot. If it's, a bank down the street and they've only dabbled a little bit in HOA banking, I can promise you there's going to be a lot of issues in opening those accounts, maintaining those accounts, and keeping information current. Another question is, do you have a representative that can attend your board meetings? So again, if you want that recommendation from the bank, you're definitely not going to get it anywhere, right? It's going to be someone who specializes in HOAs and community associations. Can they attend board meetings? I know right now we're doing a lot of Zoom meetings because we're unable to get together in person. But when that's lifted too, can they attend our board meetings after hours? Or do our board members, do they have to go to your branch between 9 and 5? And does it have to be every board member? These are just questions to start thinking about whenever you're looking to place funds in a wealth management type of account, or local banks because they have the best rates. And then can the bank can they communicate with all management company staff and board members? This one's huge. The management staff is doing all the work, right? They need to reconcile accounts, they need to provide financials. And how are they able to do that if they can't have access to the accounts or have access to even bank statements? So another question that you definitely want to ask your banker is, what other products do you offer HOAs, right? So let's say you've done your due diligence. The associations, they have a reserve study. They're planning and they have all their money protected. But let's just say that's not enough, right? They're not fully funded and they have a huge project coming up. So with that, I'm going to turn it over to Andrew, and he can definitely talk about underfunded reserves, and we will come back to this question.
Perfect. Yeah. So underfunded reserves, obviously not the situation anyone wants to be in. And it happens for a multitude of reasons. And so what we're going to look at today, this is an actual client we worked with. And this is a more extreme example because obviously it's going to paint the most impressionable story on everyone here. But what I wanted to show is, what was the situation, how the reserve study was used for the community, and also how the reserve study worked with the lending side of this, and then sort of how the community got through it. And so to set the stage, this is a high-rise structure. So it's 25 stories, 156 units. And a key thing here is it was an older building, built in 1968. I believe we were at this property in 2017 or 18, if I recall correctly, so a few years ago. But regardless, it was already definitely an aging property. And when we went in and worked with them, they currently had a balance just under $300,000. they were contributing annually about $274,000. But the big shocker here was in the next 5-year time horizon, they had over $6 million in capital projects. Now, again, this is a really drastic example, but it really sort of helps you see how this all sort of plays together. And one other thing just to hit on here, we'll see where it ends up, but if we look at their current annual reserve contribution amount, what was interesting in this for this property was they had no knowledge of a reserve study ever being performed. Now, again, it was an old property, so sure, a decade or two ago, maybe one was performed, but if today no one knew about that, that obviously meant they weren't following that funding guidance. So we don't really know how or why they came up with this annual reserve amount. And I highlight that because so often we'll ask, well, Andrew, give me a rule of thumb, like approximately what should we be reserving? And there's really, honestly, no way to do that because it's based on what you currently have in reserves. It's based on what are the upcoming projects. And then by balancing that's how the reserve contribution amount is figured out. So remember that 274 number because we'll see where they ended up even after getting this large loan. So those are the numbers. Once we went out there, we worked with this property. Now they already knew they had some serious things coming up. Like this wasn't a, hey, let's get a reserve study. Oh, wow, we found out we have $6 million to spend. It was probably more along the lines of, we know we have 5 million or so, and we also then enlighten them to a couple more major projects. So here, project prioritization. Again, they knew about a lot of these. Some of this was maybe accelerated slightly or grew in scope based on what we observed at the property. But also important is what's not listed here is we were able to work with them to figure out what could we defer. And obviously deferring projects, we have to be very careful. That's a whole nother topic we could explore one day. But that was the one of the sort of secondary or tertiary benefits was helping them get a game plan of what are we going to do, when are we going to do it, and having that roadmap moving forward. So these were the major projects that were identified. And so what did this look like? Well, here's that chart. I'm an engineer, so of course I love charts and numbers. And what's really different for this one compared to the one we saw earlier is we have this huge purple column on the left-hand side. So what happened is once the reserve study was created, we clearly identified the 30 years of expenditures, but critically those next 5 or 6 years, they had nowhere near enough funds. And so they had to borrow. And when I say borrow, I sort of view you have two ways. You can borrow from the homeowners, i.e. special assessment, or you're going to borrow from a more traditional financial institution. In this case, really you can't go to the homeowners with a special assessment of this size. It would realistically not be plausible. So they had to go to a bank. And so the reserve study is typically required, or I would say more or less required by the bank. And I think Cynthia may touch on that and sort of the why, but they want to understand, well, what is all happening, because they're a bank and they don't necessarily know the structure. So the reserve study was paramount to setting that stage so they knew how much to lend and they knew that they were covered. And so in this case, it ended up being about a $4 million loan. In this case, also, it was a pretty long amortization schedule. It was 20 or 21 years. And I don't know, Cynthia may share if there's a rule of thumb. I think she talks about some typical timelines. That seemed long from everything I've seen, but nonetheless, it was also a large project. So what that did was that gave them that huge influx of cash. As we see, that blue line is now way up high. And they drew that down considerably low over the next 4 or 5 years. And then slowly over time, they built that up. And then near the end of the study, we see that it also draws back down again. And so real quick, before I let Cynthia share about how the banks sort of tie into this, I just want to go back to that, how much should we reserve? Again, this property was at $274 a year. And even with this infusion of cash, now, of course, they're paying it back through reserves, but they still had to get that annual amount up to about $750,000 annually. And then it's inflated year over. So, I mean, you just see that they were drastically off track. But I also like to mention that because let's fast forward a few years. Like, this is going to be a real challenging time for this property. And if we think, let's get out to year 2025, they're now contributing $750,000. They are happy to be through these major projects, and that reserve balance is just building and building. It's very easy to start to think, oh, well, maybe we could reduce these dues, or maybe we'll just flatline for a few years. I just want to encourage everyone, don't fall into that trap, right? Keep the big picture in mind, because again, go to the right side of this chart. If we don't keep funding at those levels in 2045, I know that's not tomorrow, but in 2045, they're going to be right back into the position they are today. And they're in the position they are today because 2 or 3 decades earlier, they weren't on a track. So with that, I think that's all I have to share. Yeah, so I'll let Cynthia share. So from the bank side, in this scenario, what exactly happens, how an association goes through this process?
Yes, so let's look at basically what a bank requires. This is going to be items the bank is going to ask you. So if you have this information for your initial conversation with your banker, it might be the best. We are going to look at delinquencies. That's a huge, that's kind of a black and white for most banks. So you've heard 10% or less, some are 8% or less. And really the community does not have a credit report, right? We don't know what the history is on this community. So we want to make sure the association can pay regular assessments, but also pay a loan payment. You definitely want a total minimum number of units should be around 25. I've heard anywhere from 18 to about 30. Again, if it's a large dollar amount, we want to make sure the number of units can support that, right? And they can pay back with regular assessments. Or if a special assessment is needed, we're going to be able to determine that based on the dollar amount and the number of units in that community. Investment owned should not exceed over about 40%. That's pretty industry standard. And that's just to, again, make sure that the loan payment doesn't fall on one individual. Does the association have the right to borrow? So definitely review your governing documents, make sure the association, number one, can borrow, and number two, can pledge future assessments as collateral. Okay, so that's going to be the bank's collateral. It's definitely not the pool, furniture, or the clubhouse, or the fence. We want cash. So number one rule of any bank is just to get paid back. So what we're doing is just looking at requirements to see if a bank can lend to you. The bank will also review income versus expenses and make sure, again, there's enough money left over to make that loan payment. Okay, next is the lending options. So of course, every bank is going to be different, but this is kind of industry standard for, again, HOA banks. There is a smaller quick-term loan option that's usually for loans under 3 million. There's various terms from 5, 7, up to 10 years. Usually it's a faster loan process. It's a quick application and approval and funding within a couple weeks. Andrew mentioned something about the term of the loan. Usually we want to match the term of the loan with the useful life of whatever component it is. So if it's a painting job, we're definitely not going to go out 10 years. If it's roofs, 10 years works perfect because roofs last longer. So we definitely are going to utilize that reserve study to see the useful life. We'll also want to make sure that in the term of the loan, let's say it's a 10-year loan, and it is for roofs, we want to make sure in those 10 years, what else does the association have to do, right? So do they have a major road replacement in 5 years? We don't want the association to have to come back to the bank and say, hey, we also have road replacements in 5 years. We need another $500,000. So we're going to, again, be that consultative, we're going to take that approach and really talk to the board and to the managers and say, hey, we noticed you also have this road repair coming up in 5 years. Let's lump it together and get a larger loan so that you can get all the work done instead of coming back to the bank. Okay, the traditional loan, that's for larger loans, usually over between 2 million and above. And that, again, is various terms, 5, 7, 10. We can also go up to 15 years, again, depending on the work that's being done. This is, let's see, the opinion letter is also required for these larger type of loans from your counsel, legal counsel. So you definitely want to get them involved early in the process. Again, because they will be writing that opinion letter for that association saying, again, they can take out a loan and they can pledge future assessments as collateral. The revolving line of credit, it's an emergency line of credit that some communities already have just open just in case there is an emergency. hurricane, if the hurricane's about to come through, and, Andrew already mentioned the pool furniture. So if that was in place to be replaced in 5 years and the hurricane just blew everything away, the association can use this line of credit, emergency line of credit, to replace the pool furniture now, and then with the intention of paying back usually in the next 12 to 24 months. So there are yearly renewal fees to keep that line open, but it's, again, really there for emergencies, nothing that you need to pay for. The great thing about loans, again, when you're dealing with HOA banks, is future assessments as collateral. There's no personal guarantee for the board members. So the board is assigning on behalf of the corporation and not personally liable for anything. So that's about it. So before turning it back to Jesus for questions, we just want to say thank you for allowing us to talk and to educate, and for you to be here. We're always happy to help. You can always reach out to Andrew or myself, and we're happy to help or talk to your board one-on-one to really figure out what it is that they're looking for.
Thanks, Cynthia. Great information, Cynthia and Andrew. I certainly learned a lot. I said, Cynthia, let me just send this first one over to you. Can you compare and contrast the CDARS, CDARS, and FDIC option versus surety type programs? Oh, you're muted. Hang on a second.
Sorry about that. Cedars is a true CD product, and that's all they offer is CD products. Under the surety bond, there are multiple different products. So there's money market accounts, there's CDs, there's also CD ladders. So there's multiple products in the surety bond process or portfolio. Okay.
Is that something offered by, I guess, CIT and other banks? Is it a product?
Yes, so you definitely talk to your banker. A lot of banks do offer it, some don't, but definitely ask that question.
Okay. This one for you, Andrew. Can Andrew discuss how often reserve studies should be updated?
Yeah, question we get a lot, and I like to answer with it depends. But when I need to give a number, what I like to say is 3 to 4 years. That's usually the sweet spot. There's times where maybe 5 years is fine, but as soon as we start to go past that, reality always diverges from the plan. And the more time that goes on, the bigger those course corrections are going to be. And so, among other reasons, that can be a big factor why we don't want to go too long, just because of the shock of readjusting and realigning. So 3 to 4 years is what I like to say.
Okay. This one for you, Andrew. Can an HOA use reserve studies to buy real estate property?
Say that again. Can
an HOA use reserve study funds to purchase real estate property?
So similar to something I think Cynthia said earlier, for any association, you always need to look at your governing docs, because there very likely could be stipulations there, which would be sort of most restrictive. Secondary to that, we don't actually have any state statutes that strongly control reserve expenditures. So in some states, that would also be a control. Here it's not. But then third, as I said when I was looking at that expenditure schedule, if it's not identified on the reserve expenditure schedule, it's not being allocated for in reserve funds. And so if you also talk to your CPA, they're going to say, following GAAP, their general acceptable accounting principles, they're not going to want you typically to spend that on anything else. And also, if we think back to, well, how is that reserve expenditure schedule determined? Well, we go back to that 4-part test. And so prospectively buying real estate doesn't do that. The one thing I would say to consider is what we do see is lots of associations at time in the year with large surpluses. And I think it's great when we transfer that over to reserves. One thing to think about is before we've actually clearly allocated that to reserves, maybe a separate account that's fully delineated from reserves would be more applicable. Because, prospective real estate purchasing, I haven't gotten that question, but a similar situation is we want to build a brand new element, which we don't have. We don't have any tennis courts. We want to build new tennis courts. Same thing really should be funded outside reserves. Once it's an asset, then the reserves would account for it from a future standpoint.
Good answer. Here's one that should be a relatively easy one. What is the median rate for a reserve study? What does a reserve study cost? I don't know.
Oh,
I'm sure it's all over the board.
yeah, that's probably even more all over the board than the time to update. The way I like the easiest answer is any provider can give you a quote in a very short order, and every provider that does reserve studies, it's a single fee. It's this is the cost. There's no surprises. That's honestly the easiest way, because if that's a person that is an on-site manager at a downtown high rise, that is a whole different type of range compared to maybe a tiny HOA. Like earlier this week, I was at a 50 home HOA with a gate. So it's a couple $1,000s to over 10,000 at times. It's really hard to answer that one.
That's a tough one. Can reserve study be updated, or do you have to complete a new survey? I guess that's a general question.
Yeah, that's a good question. So reserve studies, there's levels of them. So there's 4, but we're really talking about 3 levels. So level 1 is a full study that's from scratch. Level 2 and a level 3 are what's called update studies. The difference between those is you can update a study and return to the site, or you can actually do an update to a study where you don't return to the site. So obviously level 1's the most detailed. Level 2 is an update, you still return to the site. But to specifically answer the question, can you update a study? Yes. And so the big difference when you are performing an update is you're not re-quantifying. You're not having, and if you don't do the site visit, you're also not recondition assessing. But yes, you can update previous studies, and updates, because commonly this is where the question goes, are of cheaper cost than a full study. There's obviously times where it makes sense to get a full study, even if you have a previous study on a multitude of reasons, but hopefully that answers the question.
Okay. Cynthia, I'm going to throw this one your way. It's a little bit of a comment and then question, but it speaks to the transition between boards over a certain number of years, and asks, has anyone found any way to instill the necessary discipline in future boards to follow the reserve plan? Any advice?
Well, I think that kind of ties back into the investment policy. If you create that with a board, and future boards should kind of just get in line, and that should be the guide for that association moving forward. Of course, you want to get that recorded and make it a recorded document so it can be, implemented. Of course, that could be changed as well. So it might need to be something that is looked at in your bylaws, that you add something to your bylaws, amend your bylaws. That's a big undertaking, and I know it takes a village to do so, but you might want to look at that if the investment policy isn't there, or is there and isn't being utilized. But that's a great start.
Good feedback. I guess, Andrew, this would be for you. We've got 2 more, this one and 1 more, and then we'll cut it off there. If an expenditure for a pool mechanical room is set for a certain year, but expenses for replacement of pumps, filters, electrical components occur outside the target year, should those costs be allocated to the reserve line for the pool mechanical room, or the operating budget as a maintenance line?
That's a loaded question. I love it. So to answer the bulk of it, if the pool mechanical equipment was scheduled in 4 years and you need to replace, let's make it simple. For whatever reason, you need to replace it all, every pump, every filter right now, go do that, spend reserves. That's just a case of reality didn't match forecast. That's totally fine. The question got a little more fun when then it ended with the, well, is that actually just maintenance, or should that be operating, or is that capital repair? That's a fun conversation point. But to stick with the pool mechanical equipment, when the reserve study has the pumps, the filters, controllers, when those are scheduled and allocated for in reserves, if you go tomorrow and you have to put 1 new filter in, it's still totally appropriate to expend reserve funds. Now, I think I said it earlier, at the end of the day, if you end up saying we're going to spend that from reserves, or we're going to expend that instead from operating, it's not that that's wrong to go spend that from operating, because it's still the association's money. It may just mean we spend a little more on the operating side and the reserve balance is a bit higher. But I do really like that question.
Awesome. Last one for you, Andrew. If you are planning on putting in a new capital improvement, such as a gym or workout room or a new park, can you include it in the reserve study before it is built? Is that
Man, you're leaving me on a challenging one. What I would say is the initial expense to add that element should not be in the reserve study. And actually, there is a link, and Jesus, maybe we can share this out on the CAI's national website. There's actually a link to an article that they put together. I think it's called something like an explanation on the National Reserve Study Standards. Whatever it is, we'll link that and share it. I believe it talks specifically to this, but yeah, to say it again, if you don't have a park at all and you want to go make a park, that initial cost really should be funded outside of reserves. Once it's there, it's now a reserve expenditure. It starts to get gray as if you have a park, but you're significantly enhancing it, then that gets a little more challenging to figure out. But that's how I would answer that one.
okay? Well, we've got now we got to select some winners. I appreciate everyone's time, Andrew and Cynthia and Jeff, for your sponsorship. This was great information. I certainly learned a lot. We had 110 people sign on, so that's a really good return right there for us. I think it was good information for all involved.